Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to continue IFRS 9, Financial Instruments. In our previous lectures, I have covered the key concepts of financial instruments, IFRS 9, looking at the classification of financial assets as well as financial liability. Also, I have covered the concept of compound financial instruments as well as the preference shares. So basically, today we are going to look at the recognition and measurement of financial assets, to be specific. I've already covered the concept of financial liability in detail. So today we are going to start financial assets. And also within this session, we are going to cover when are we going to recognize fair value through profit and loss, and when are we going to use the fair value through the other comprehensive income. Very important concept and very important distinction that you need to know for the examination. To be specific, for the strategic business reporting students, you need to know how we can classify a transaction through the fair value of profit and loss, as well as how we can classify a transaction under the comprehensive income. Also, we are going to look at the hybrid, in which situation we can able to convert from other comprehensive income to the profit and loss account. That particular concept, we are going to look at it for the strategic business reporting points of view. But for financial reporting, you don't need to worry about how we can reclassify from the other comprehensive income to the profit or loss, or from the profit or loss to the other comprehensive income, which might not be the case. So we are going to look at how we can reclassify from other comprehensive income to the profit and loss, because um, when we are talking about the profit and loss as well as the other comprehensive income, they are not the same. They are distinct, and also, their accounting treatment are not the same. Also, the impact on the financial statement, they are not the same. So we are going to look at it in detail in this section. So basically, IFRS 9 deals with the recognition and measurement of financial assets. An entity shall recognize a financial asset on its statement of financial position when and only when the entity becomes party to the contractual provision of the instrument. If you are looking at the definition of financial instrument, there should be a contract, and the contract should contain a financial asset as well as a financial liability, period. So if we are talking about the financial asset portion, the entity should only recognize the financial asset when the entity becomes party to the contractual provision of that particular instrument according to IFRS 9. The initial measurement of financial assets is very clear. At the initial recognition, all financial assets are measured at fair value. All financial assets at initial recognition, they are measured at fair value. It means at the contract inception of the financial assets, then we are going to recognize all financial assets using the fair value. The fair value will be given in the question, and we are going to cover IFRS 14 fair value measurement. So don't worry, for financial reporting examination, the fair value will be given. And for the strategic business reporting student, you need to know how you can use to calculate to ascertain your fair value using the various input output method to determine the fair value, looking at the market condition and looking at other factors to determine the fair value according to IFRS 13. So don't worry for financial reporting students. So what you need to know is that all financial assets at initial measurement, we are going to measure it using the fair value. This is likely to be the purchase consideration paid to acquire the financial asset. Very important concept you need to know. Transaction costs are included unless the asset is fair value through profit and loss. So now we are going to include the transaction cost unless the asset is at fair value through profit and loss. So if we are going to account for the asset under the fair value through profit and loss, then we don't need to account for the transaction cost. But other than that, we are going to include the transaction cost within the initial measurement of a financial asset. So you need to note it down. So now we are going to look at the division of financial assets into two. We have the equity component of financial assets. We have the debt component of financial assets. Now, for example, if I purchase shares in X, Y, and Z company, automatically in my financial statement, I am going to recognize the financial assets as investment in X, Y, and Z company. So with regards to that investment, I have the option to either value the investment at fair value through profit or loss, or I'm going to use the other comprehensive income approach, depending to the purpose in which I have invested my money into that particular company. The purpose, the business model, and the contractual cash flow test will determine whether we are going to recognize this transaction as a fair value through profit and loss, or whether we are going to recognize this transaction as other comprehensive income. So key distinction, that's when we are talking about the equity instrument. So now we are going to look at fair value through profit or loss. But before going to the fair value through profit or loss and fair value, and other comprehensive income, I want to give you a brief background and detailed understanding between profit and loss and other comprehensive income. So profit or loss, right? And you are talking about other comprehensive income. Other comprehensive income. So now when we are talking about profit and loss, when we are talking about profit and loss, it means all business transaction, on all transaction on normal course of business operation for that particular period, we are going to recognize it as under the profit or loss component. Very important. So we are going to show the result of normal business transaction for the period. Key point that you need to know: second important point, in most cases, this is the figure. This figure is called net profit in our old days, net profit or loss, whichever, right? Also, this is used to assess the profitability of the company, looking at the performance as well as the profitability. So now we are going to the performance, the operational performance and profitability of the company. Very important point. Now let's look at other comprehensive income. So when we are talking about other comprehensive income, it includes income and expenses, not, very important point, not recognized in profit or loss. So now when you're talking about income and expenses not recognized in profit or loss, we are looking at, for example, if you can remember when I covered IS 16, property, plant, and equipment under the fair value, the revaluation concept, increase in revaluation or revaluation gain, we can recognize it as other comprehensive income. Why? Because the fundamental concept is that, according to prudence concept, gain can only be recognized if it is actual. If we can actually earn that particular gain, then we can recognize it. Other than that, we are not going to recognize the gain. So this is the situation why we are going to show the gain as other comprehensive income, because in actual sense, the evaluation is just an accounting calculation. It's just an assumption that the asset value will increase from 5,000 to 7,000, for example, but it does not contain an actual, gain within the business. So we are going to recognize it as other comprehensive income. So income and expenses not recognized in profit or loss, we can recognize it as other comprehensive income as required. Very important. As required by IFRS or IESs, whichever accounting standard. Another key point that you need to know, in most cases, it often relates to unrealized gains or losses. In most cases, it's due to unrealized gains or losses. Another key important of other the comprehensive income, it focuses on long long-term value chain rather than on annual or periodic basis. Very important concept. Now, when we're talking about the evaluation, we are not going to do evaluation on annual basis. Even if we are going to do the evaluation on annual basis, it might possible that there will not be an increase or change in the fair value of the asset. So it is more about the long-term aspect, not the short-term performance of the company. So basically, because of these reasons, you need to know the distinction between the profit and loss and the other comprehensive income. Also, we need to know in which particular area they are applicable. Now, for example, if we're talking about an example of profit or loss, we are going to look at the revenue, the cost of sales, the gross profit, for example, the operating expenses, the finance cost, the taxes, the net worth. All of these guys can be found within the profit or loss. Then also, if we're talking about the other comprehensive income, for example, we're going to look at the evaluation gain, and also that's according to IES 16. Also, we are going to look at the fair value changes of equity investments. That's what we are going to look at according to IFRS 9. And also, if you can remember when I covered IES 21, the foreign currency, when we are going to retranslate the translation differences, we are going to account for it as within the other comprehensive income. Also, if you're going to look at the cash flow hedge reserves, under IFRS 9, but don't worry about cash flow hedge reserves, for this level. And also, what can be classified as fair value through the comprehensive income is when we are going to look at the IAS 19, the employee benefit, the actual gains or loss on the employee benefits, we can account for it under the other comprehensive income. So basically, because of this distinction, further aspect of the reclassification from the comprehensive income to the profit or loss is very, very much important. So now let's try to analyze some distinction between the profit or loss and that of the other comprehensive income. Now let me profit or loss, right? Or let me area profit or loss and other comprehensive income. Very important. So now we are going to look at the nature. The nature, yes, nature. Yes, let's look at the nature. By nature, the profit or loss is operational. By nature, this is non-operational. Because if we're talking about evaluation gain, we are not the fundamental basis of existence for the company is not to revalue their property, is to buy or sell whichever product or whichever services they are rendering, not to revalue their property to have access to the evaluation gain or the loss in the property. So basically, that's one nature, one distinction between the profit or loss and the other comprehensive income. Also, we are going to look at the frequency, very important concept, the frequency. So now if we're talking about the frequency, right, for profit or loss, it is regular. While for the OCI, it's often irregular. And also, we are going to look at the main use, very important concept, the main use of OCI as well as the profit or loss. We are using the OCI for performance basis, the profit or loss, sorry, whilst we are using the OCI for to effect the possible changes in value. So we're going to look at the value changes, or we're going to look at the risk exposure. So these are some basic comparison, and also very important. Where are we going to treat um, these guys? Right? We are talking about retained earning when we are talking about the profit and loss, and also we are talking about the OCI reserve. If you can remember, when we looked at IAS 16 property plant and equipment, the evaluation gain, we are going to debit other comprehensive income, and what are we going to do? We're going to account for it under um the the evaluation reserve, very clear. So basically, this is what we are going to look out for when we are going to compare between the OCI as well as the profit and loss. So very simple. So the gain on evaluation, we are going to show it as assets, and we are going to show it under the comprehensive income instead of we are going to show it under the profit and loss, for example. So very simple concept that you need to know, and it's a clear distinction for you. So basically, we are going to look at what IFRS 9, how are we going to account for the fair value through profit or loss as well as the fair value through other comprehensive income. By default, all equity investments will be carried at fair value through profit or loss by default. So if there is no indication about whether we are going to look at the business model or the cash flow test, then we are going to assume that this particular equity investment should be accounted for using the fair value model through profit or loss. Any transaction costs associated with the purchase of investment are expense to the profit or loss. Any transaction cost, we are not going to include it. We are going to expense it at once. Very important point. This is one of the distinction between the fair value to profit or loss and that of the other comprehensive income. How we can account for the transaction cost. So when you are studying, these are the key points that you need to know. Transaction cost for the equity investment under the fair value to profit or loss, we are not going to include it. We are going to expense it. We are going to show it as an expenses. The investment are then revalued to fair value at year end. So on annual basis, we are going to revalue the investment. We are going to revalue the financial assets with the gain or loss shown in the statement of profit or loss. So this is the reason why it is called the fair value through profit or loss. It means if the investment value appreciates, then we are going to account for that appreciated value in the statement of profit and loss. Also, if the fair value of the asset, decreases, then we are going to account for the loss in that particular investment. So this is the concept. Now, for example, um, the 1st of January purchased shares in X, Y, and Z company for $4 per share. Then at the end of December, the share value has appreciated to let's say 4.5. Now the 0.5 per share, we are going to account for it as a gain on the fair value, which will be shown in the statement of profit or loss. We are going to show it as fair value gain to profit or loss. If there is a loss, we are going to show it as well. So now 2 points that you need to know about the fair value through profit or loss. One is the transaction cost. Transaction cost, we are not going to include it in the initial recognition. Instead, we are going to expense it. Whilst if we are talking about the fair value, the evaluation of the fair value, if there is a gain, if the fair value appreciated, then we are going to show the gain in the statement of profit or loss. If there's a loss, we are going to show the loss in the statement of profit or loss, period. So now we are going to look at the fair value through other comprehensive income. Instead of classifying equity investment as fair value through profit or loss, an entity may designate the investment as fair value through other comprehensive income. This designation must be made on acquisition and can only be done if the investment is intended as a long-term investment. Very important concept. We can only designate this particular transaction to be fair value through comprehensive income if the intention of the purchase of that particular equity investment is for a long-term investment. Other than that, we are not going to account for it as fair value through other comprehensive income. And this accounting treatment should be agreed, should be designated before or on the inception of the contract. At the acquisition date, you need to make it very clear that the basis of acquisition is for X, Y, and Z. Based on the parameters, they are long-term investments. So we are going to designate it as fair value to or comprehensive income. Other than that, we are going to use the default approach, which is the fair value to profit or loss. Once designated, this category cannot later be changed to fair value to profit or loss. So under the fair value to OCI, transaction costs are capitalized. Very important concept. Under the fair value to comprehensive income, we are going to capitalize the transaction cost. Why? Because it is long-term investment. It is long-term in nature, more than an year. For profit or loss, we are going to expense it. Note the distinction. Investment revalue to fair value each year end with a gain or loss being shown in the other comprehensive income and taken to the investment reserve. Very important concept. For the revaluation gain, we are going to show it as other comprehensive income and investment reserve, not on the profit or loss account. So basically, these are the distinction between the fair value to profit and loss and the fair value to other comprehensive income. This is similar to evaluation of property, plant, and equipment under IAS 16, which is clear. The main difference is that the investment reserve can be negative. Don't worry about that. If a fair value through OCI investment is sold, the investment reserve can be transferred into retained earning or left in the equity. So now what they are saying, this is one of the reasons why we are going to reclassify from OCI to profit or loss if the investment in the financial asset investment is initially classified or designated as fair value through OCI, but at the end of the period, they decided to sell that particular investment. Then that investment, that sales on that investment, we are going to transfer it to the retained earning. When we are talking about transfer to retained earning, it means we are going to effect it or we are going to leave it in the equity component. No problem. So now we are going to look at further analysis, further explanation. The normal expectation is that equity instruments will have the designation of fair value through profit or loss, with the price paid to acquire the financial asset initially regarded as a fair value. This could include unquoted equity investments, which may present problems in arriving at the fair value at each reporting date. However, IFRS 9 does not include the general exception of unquoted equity investments to be measured at fair value. Instead, it provides guidelines or guidance on when cost may or may not be regarded as a reliable indicator of fair value. Don't worry about that. So basically, if we are going to talk about how we can account for the equity instrument under the financial assets, this is what you need to know. How we can account for the fair value to profit or loss, and how we can account for the fair value to other comprehensive income, as well as the distinction, which are two, the transaction cost, as well as how we can account for the gain or loss on the revaluation. For the transaction cost, for profit or loss, we are going to expense it, whilst for OCI, we are going to capitalize it. We are going to include it at the initial measurement. Whilst for the whilst for the accounting treatment for the gain or loss on the evaluation, for profit or loss, the gain or loss on evaluation, we are going to show it under the profit or loss. Whilst for the OCI, we are going to show it under the OCI, and also we are going to show it under the investment results. Simple as drinking pure water. So now we are done with the fair value, with the equity component of the financial asset. So now you're going to look at the debt, which is a little bit technical, and it is synonymous to that of the liability aspect using the amortized cost. So now under the debt aspect, it's very clear. For example, the company I obtained, or I gave out a loan to my employees, which is very clear. So in that particular situation, that I'm going to account for it in my book, I'm going to account for it as financial asset, because on quarterly basis, I'm going to receive money from the employee, or I'm going to deduct it from their salary, whichever condition it might be, which is fine. The most relevant point is that on annual basis, I'm going to receive money from the employee. So now, if that is the case, we need to know how we can account for it, whether we are going to use fair value to profit or loss, or whether we are going to use fair value to other comprehensive income, or whether we are going to use fair value to amortized cost. You can remember the concept of amortized cost under the financial liability. Also, you can remember the concept of the lease liability table under the lease accounting. Don't worry. Let's understand the debt instrument of the financial asset portion. We are going to measure it using the three categories: fair value through profit or loss, fair value through OCI, or the amortized cost. The default category is again the fair value through profit or loss. By default, if the question is silenced, if no indication is given in the question, then we are going to assume that we are going to account for this particular transaction under the fair value through profit and loss. The other two categories depend on the instrument passing to test. Very important to note for objective test questions. You need to know why I'm emphasizing on the distinction between key points is for you to able to understand, because in objective test question, these are the points that the examiner will be used to test students to understand, to assess whether the students understand the concept. For example, they might include, an illustration of the profit or loss as well as the OCI. Then you can drag and drop. For example, if the option A is talking about fair value through profit or loss, two options. We have the option of transaction cost, then we have the option of the fair value. They can ask you which one you need to drag as part of the fair value through profit or loss, or which one you need to show as other comprehensive income. So you need to know distinction. But whenever you are studying, you need to know the technical point that's very much important for the examination. So now for amortized cost and fair value to other comprehensive income, we are going to use these two categories depending on whether the instrument pass the two tests. One of the tests is the business model test. Another test is the contractual cash flow test. When you're talking about the business test, consider the entity purpose in holding the investment. I mentioned it earlier. If the purpose of investing in X, Y, and Z company is to secure a long-term position, or is for you to move your business model to a different dynamics, or you want to diversify your investment portfolio, whichever the basis should be, we need to know the purpose of holding the investment. If the investment is held for if the investment is held for capital appreciation within an year, then we need to look at it, whether we are going to account for it as profit or loss, or as other comprehensive income. So the basis of holding the investment is very important. So now we are going to look at the contractual cash flow characteristics. Look at the cash flow that will be received as a result of holding the investment, and consider what it comprises. So now, if I'm holding investment in X, Y, and Z. I'm going to look at the cash flow that I'm going to generate, that I'm going to receive from that particular investment. Then I'm going to use that as a basis to determine whether we are going to classify this as profit or loss or other comprehensive income or the amortized cost. So you need to know the two um, tests that the amortized cost and the fair value to other comprehensive income should meet. So very important concept, whether the instrument should meet the fair value through other comprehensive income or whether it should meet the amortized cost. So for us to classify the fair value through other comprehensive income or amortized cost, we need to ensure the conditions stated by IFRS 9 are met. The business model test and that of the contractual cash flow test. So now we are going to talk about the amortized cost. For an instrument to be carried at amortized cost, the two tests to be passed are the business model test and the contractual cash flow test. Other than that, we are not going to account for it under amortized cost. If a debt instrument is held at amortized cost, the interest income, you can remember the amortized cost for the lease liability, the financial liability. We are talking about interest expense and we are talking about the interest payment. In this situation, we are going to look at the interest income calculated using the effective rate as for liability. You can remember we are going to calculate it using the effective rate. While effective rate will be taken to the statement of profit or loss, and the year-end value is similar calculated using the amortized cost table. So now we are going to look at it. Very simple. We are going to look at the interest income. This we are going to use the effective rate. We are going to use the effective rate. So we are going to use the effective rate for the interest income. Then for the payment received, we are going to use, obviously, we are going to use the nominal rate, or we are going to use the rate attached to the investment, the rate without the content of the risks, the risk exposure, the possible impact on the transaction. We're not going to look at that rate. So we are going to use the nominal rate. So now, for amortized cost, this is what we are going to use to account for the financial assets. Nothing changed. Don't worry about it. We're going to use the same approach as for the financial liability. In this situation, we're going to use interest income and payment received instead of interest expense and payment made or interest paid. That's the only distinction. So now, for the fair value through other comprehensive income, for an instrument to be carried at fair value through OCI, the two tests to be passed are the same test, the business model test, and that of the contractual cash flow test. If a debt instrument is held at fair value through OCI, very important. Asset is initially recognized at fair value plus transaction cost, nothing changed. Interest income is calculated using the effective rate, same in the same way as the amount that will have been recognized in the profit or loss if using the amortized cost. Simple. Assets will be revalued to fair value at the reporting date with the gain or loss to be recognized in other comprehensive income. Same. This will be reclassified to profit and loss on disposal. Nothing changed, nothing to worry about. Same concept as for the equity investment. The only distinction in this situation is that for the debt component, we are going to use the amortized cost in addition to the two existing, measurement or recognition system that we are going to use, which is the fair value to profit or loss or the fair value to other comprehensive income. So basically, this is a contractual cash flow test. You can go through it, you can read it, nothing much, just to expand on your understanding. Debt instrument, you can read it as well, nothing to worry about. So let's look at example one so that we can have some feeling about what we have covered so far. So now, what amount will be shown in the statement of profit or loss and statement of financial position for the financial assets over the period of investment? On 1st January 20x1, an entity invests 5,000 in 10% loan, the nominal interest rate that we are going to use to calculate the cash received. The loan note is repayable at premium So automatically, if it can be repayable in premium, it means the effective rate must higher than the nominal rate. The effective rate is 12%. The company intends to collect the contractual cash flow, which consists solely of repayment and interest and capital, repayment, interest, and capital, and have therefore chosen to record the financial assets as amortized cost. So now look at the condition. According to IFRS 9, we can account for the transaction as amortized cost if the two tests are met. One is the business model test, the purpose, the intention of holding the investment. Secondly, you're looking to look at the contractual cash flow. That's how are we going to receive the cash flow from this particular investment. And in this situation, the intention is to collect the contractual cash flow, which is clear. And also the cash flow we are going to receive is the interest as well as the capital at the end of the period. So now we are going to use amortized cost to calculate. We're going to use solution. I'm going to use amortized cost. So we're going to look at the year. We're going to look at the initial value. We're going to look at the interest income, which is calculated using the nominal value at 10%. Sorry, at using the effective rate at 12%. And also we're going to look at the cash received or interest received at 10%, the nominal value, and we're going to look at the closing value. Year one, the initial value is 5,000, which is simple 12%, 0.12 multiplied by 5,000, 600. 10% is 500. So the answer will be 5,100. Year two, 5,100, nothing changed. 12%, 5,100 multiplied by 0.12 will give us 612, and the interest received will be the same throughout. And 5 plus 5,100 minus 500 will give us 5212. Then here 3, 5212 multiplied by 0.12 will give us 625.44 minus, we are going to the company intends to collect the cash flow, repayment of interest and capital. So at the end of year 5, the interest is 5,000 plus the investment 500. Then nothing to worry about. 5,512. This is 5212. 5212 plus 62.44. 5212 plus 5212 multiplied by 0.12 plus 5212. So basically, this is how we are going to account for this particular transaction. But look at the requirement. What amount will be shown in the statement of profit or loss? So basically, we are going to show this under the statement of profit or loss. Statement of profit or loss. We are going to show 600. 600. We are going to show 612. We are going to show 62. 625.44. And also the financial position, the assets, we are going to show 5,100. We are going to show 5,212. In year 3, we are going to offset everything. We are not going to show any financial asset or financial liability. So no financial assets in this situation. So basically, this is the concept, and this is how we are going to account for it. Now let's look at example 2. Let me look at my time. Okay, we're going to look at example 2. Prepare an extract from the statement of profit or loss for the year ended 31st December 20x7 December, and the statement of profit or loss. Now, the entity invested 10,000 shares of a listed company in November 20x7 at a cost of 4.20 per share. At 31st December, the share price has a market value, which is very simple. So now, if we're going to look at the test, this particular transaction did not meet the amortized or the other comprehensive income test, which is the contractual cash flow and the business model test. So we are going to account for it using the fair value through profit or loss. So now we need to calculate the value of the share. Value of share at acquisition date, which equals to 10,000 share multiply by the share price at that particular date, 4.2, will give us 42,000. And the value of the share at the year end, which is 31st December 20x7. This is at acquisition date at November 20x7. So basically, the value will equals to 10,000 multiply by 4.9. So 4,000, 49,000. So the difference will equals to 49,000 minus 42,000. So 7,000. So this 7,000, we are going to account for it as gain on the fair value. So now, within the statement of profit or loss, there will be gain, fair value gain on investment, which is 7,000. Very simple. Then the statement of financial position, we are going to show investment value as 49. Very simple. So nothing to worry about, and this is how we are going to account for it. Example 3, nothing much to worry about. Prepare an extra from the statement of profit or loss and other comprehensive income. An entity invested in 20,000 shares of a limited company in October 2007 at a cost of 3.8. At 31st December 2007, the share have a market value of 3.4. This will be a loss. The company is not planning on selling these shares in the short term. So automatically, if they are not planning to sell the shares in short term and elect to hold them as fair value through other comprehensive income. So we are going to use this approach as fair value through other comprehensive income to solve this. So you are going to solve this on your own, nothing to worry about. The loss will be at 0.4 multiplied by 20,000, which we are going to show under the other comprehensive income, as well as we are going to show it as the investment reserve, because we are going to measure it using the other comprehensive income. So the difference will be 0.4 multiplied by 20,000 shares to give us the loss, or we are going to take 3.8 multiplied by 20,000 and 3.4 multiplied by 20,000. The difference of the total answer will be the loss that we are going to recognize, and also the closing value that we are going to show in the statement of financial position as investment asset is the 3.4 multiplied by the 20,000 shares. So for financial assets, this is all what we are going to cover for today. Then we are going to look at one final session that we're going to look at how we can account for very important concept as well, the factoring. How we can account for the factoring, when are we going to include it as a financial asset or liability, or whether we are going to look at it as a secure loan, whichever concept it might be. So for today's session, thank you very much for your time.